The Thai baht hit 32.14 baht against the US dollar yesterday's morning as the regional and emerging market currencies are taking a hard beating. As many may have recalled, the baht strengthened to 28.55 baht in April, prompting the Thai policymakers then scrambling to arrest the baht rise. But after May 21st to 22nd, when Ben Bernanke, the chairman of the U.S. Federal Reserve, hinted at the possibility of winding down of the money printing program under quantitative easing, the situation has changed completely. Now the tide has turned against not only Thailand but also the BRICS and the emerging markets. US dollar funds have been heading to the exit, flowing back to the global financial centers. If the BRICS and the emerging markets, including Thailand, fail to handle the crisis of capital outflow well enough, they all could face a financial crisis and economic dislocations of galactic proportions. Of all the currencies, the Chinese yuan and the Hong Kong dollar, the Taiwanese dollar and the Singapore dollar seem to be weathering the storm relatively unscathed. The rest in Asia are reeling under heavy selling pressures. Since May 22nd, the Chinese yuan has bucked the trend by rising 0.2%. So has the Hong Kong dollar, which has appreciated by 0.1%. Other currencies have faced big sell-offs from Indian rupee, Indonesian rupiah, Korean won, Malaysian ringgit, the Philippines peso, Singapore dollar, and Taiwanese dollar to the Thai baht. It seems that the crisis of capital outflow is only at the beginning stage. After the Federal Open Market Operation meet in September 17 to the 18th, there will be clearer signal over the Fed's stance over the extent to which it would taper off its asset purchase program. U.S. bond yields are rising fast. The 10-year bond yield has now reached 2.93%, the highest level since July 2011. This reflects a growing global monetary tightening. Capital is flowing back to the global financial centers. Over the past 5 years, the BRICS, Thailand, and other emerging markets got carried away with easy money and easy credit from the funds flowing out of the financial centers as a result of the Lehman Brothers crisis in 2008. The easy money helped fuel asset bubbles, increase credit growth, boost consumption, and lead to a stock market and real estate craze. Policymakers in Thailand and other regional markets are complacent, building up a sense of overconfidence in the economic fundamentals. They believe that the US or Europe would take decades to repair the financial system and the economic malaise. Capital would stay in the markets for a long time. But this reading has proved to be a huge error. Now foreign funds have been scrambling for the exit over the past 3 months, and the pace of the outflow appears to be accelerating. This is reminiscent of the scene in the run-up to the 1997 financial crisis in Asia. In Thailand alone, some $30 billion flowed into the Thai economy over the past 3 to 4 years alone to create a boom. But now the party is over. In this region, India and Indonesia have faced the most severe situation when it comes to capital outflow because they both run high current account deficits. The next targets are Thailand and Malaysia, both relatively open market economies which are vulnerable to external shocks. Thailand in particular has seen weakening economic fundamentals, with the GDP registering minus growth in the first and second quarter against the previous quarters. It is obviously going into a recession, with falling exports into the negative territories of growth and deteriorating current account balance. Now it is time to manage the economy on the downward trend. Focus should be on stabilizing the economy and the financial markets rather than boosting growth or fighting against the global market trends. Analysis by Thanong Kantong.